So when you look back to the pre-pandemic time, so the start of this chart is February of 2020, wages have actually outgrown inflation, whether you use the CPI all or the CPI core, the wages have grown faster. So if you were making $10 an hour at McDonald's and you took a new job over at Amazon for $15 an hour, you got a 50% raise. We've seen the wages actually outgrow inflation. Purchasing power on average is more now than in the wonderful 2019 economy. So this is one way of looking at it. And that spike there in the early part of it is what happened. These numbers are averages. A lot of lower wage workers were fired disproportionately. And so the average was the remaining people that were working spiked up. And now that people have returned to the workforce, we've got a better measure. And so I wouldn't, when people analyze, and I'll show you a graph here in a second that goes into it in more detail, but the number of the people are complaining that, oh, the real wages have gone down under Biden. It's like, well, let's put that in perspective, and we'll show you that this is a big distortion that we had here in the early 2020 timeframe. So let's take a look at the next. I think it's the next slide or coming up. Not the next one. It'll be one of the soon. Here it is. Yeah, this is the one. So this is real wages. So this is real means adjusted for inflation. This is purchasing power. And a wage above $28 like it is today is incredibly high historically. That's a 96th percentile real wage going all the way back to 1948. That is an A+ wage. You are not going to see 28+ very often in your lifetime. In December of 19, it was also very high at $27.50. And if I had used the same February 2020 number, it's like $27.60 something. It's a little bit higher than that, but still well below where we are now. And what happened is this giant spike when all those low wage workers were let go, and now they've come back. And we're above the pre-pandemic. And I don't know if I've got it in here. It would be on the next slide, Carl, if I did it. Did I do the long-term view? Yeah, well, there it is. Going back, you can see how high the wage is. It was the highest it's ever been in April of 2020, but that again was that distortion that we had. And now we're still at an extremely high wage, just barely below the 73 peak. And again, people were not getting $28 an hour in January 1973 dollars. This is real, meaning these are all $2022. This is an extremely high wage, 96th percentile. So as much as the media has hyped inflation and talked about inflation as a horror story, wages are in an incredibly good place. People aren't suffering as much as you would be led to believe by that, that storyline of, oh, inflation's the end of the world. That's like just talking about the cost side of something and not the revenue side. Wages are the revenue side. It'd be like talking about how much the government spends and not how much the government takes in. Real wages are phenomenally strong. Yeah, keep going.
Well, one of the things that we talked about when Biden took office, if we think back, when Biden took office, we were just starting to get people vaccinated. And most of us were not going and eating in restaurants. And so most waitresses and busboys were still laid off and not working. And so those jobs, those lower wage jobs, were not in the averages that were being reported.
David, I have a question for you.
Yeah.
So this month, I think this month, all of us retirees that are on Social Security get a 7.5% increase. Does that get reflected onto these wages here? It's not technically a wage. It is an increase. I don't know how that would.
I don't think it's part of wages, and I have to ask Carl because Carl's really good at kind of the definitions of all these statistics. My thought is no.
You're correct, David. The answer is no. It's not. It's not in the wages that the BLS, Bureau of Labor Statistics, reports. Again, those wages are coming from the establishment survey, the companies that have payroll employees.
And we,
Thank you.
this is a point that Bill brought up a couple in the last couple of meetings. It's a really good line of discussion, is this idea that inflation doesn't hit everybody the same. If everybody's has got to eat, so we're all paying food inflation, but not everybody's renting. Not everybody had to buy a new or a used car. So it's if you are a rural person who had to buy a new pickup truck and you're driving 100 miles a day to go from gig to gig, then inflation is hitting you pretty hard. If you are a city person that owns a condo, like Carl, to some extent, he's going to pay more for food, but that's about it. So it just depends on who you are. And if you are a retiree who owns a home and is getting this nice bump up, hopefully that covers a lot of the food additional costs that you have. And, you go from there. And that's why it's so important to look at, not just these wages, which are a key part of it, but also if you're getting a cost of living adjustment, how does that relate to what your experience with inflation is? About 80% or a little higher of elderly own their own home. So they're not paying the rent inflation, which is like a third, or I think I saw something that said it was almost 40% of the inflation we're seeing lately has been driven by rent. They're not seeing that. It's not part of their world. So it's really interesting. And again, to just kind of think about, inflation is affecting people differently, just like, okay, the elderly got a 7% raise this year. I don't know what the COLA was last year. Does anybody remember? What was that cost of living adjustment a year ago? I'm going to guess
it was
4
around
or
5
5
to 6%.
Yeah. So, that chart that Carl and I just showed you for wages were up like 16%. So the cost of living adjustments over the past couple of years have probably been 11 or 12%.
Well, the other thing on seniors, one of the costs that people have is property taxes. But if senior, at least in Cook County, I don't know if this is universal across Illinois, but in Cook County, if you make less than $65,000 a year, the value of your home is locked in at your historic rate, the senior freeze exemption. And so, if your property taxes would not reflect the increase in selling price over the last few years.
Okay. That's a good deal. Because housing prices are way up. They're way up.
Hey, Bill,
All right,
It's a
keep
deal for
going.
some of us, but yes.
our Medicare
graph.
payment's going down too.
Good news.
Yeah.
All right.
And our COLA
some other-
is more than what he said. So I'm not going to say any more than that. So.
Yeah. The Fed chair did a couple of really helpful press conferences lately. If you want to hear this stuff straight from the pros, he's got an army of economists behind him. And as you know, that role is under immense pressure to get it right. And they have at their disposal some phenomenal analysis. And I think he does a really nice job of explaining it in language that people that come to the session regularly can follow, I think. And part of it is trying to teach what he does. So there are some quotes here from him from the December 14th. You can usually get a transcript from the Fed. They'll do a transcript of his prepared remarks plus the discussion with the journalists. And it's interesting to see how he tries to answer some very tough questions that journalists give him. But some key points here. Price stability is the responsibility of the Fed. It is, and I talked about this last meeting, I think it was a very bad strategic error that Democrats made by sort of accepting responsibility for doing something about inflation. It would have been a lot smarter, I think, if Biden had just said inflation is the Fed's job and they're on the case. I'm doing what I can to make sure you all have jobs and we have a record number of people that are working. He could have taken a different tack. He could do what the Fed chair does as well, which is he says, I'm sorry that people are suffering from inflation. And then he could have said, it's the Fed's job. And the Fed fully accepts that. And, we'll talk a little bit, maybe if we get some time. There was a really interesting question that Bill sent to Carl and me earlier today. And we'll probably get into that a little bit of just how much inflation is about the Fed and how they manage the money supply. It is not about government spending for the most part. it is the Fed's job to make sure that they look at what's going on and to prevent inflation from taking root, or if they choose to let it, then to address it quickly, which they are. Second part, Fed is saying, we're going to keep raising interest rates, get used to it, and we'll keep doing it until that inflation, again, that PCE inflation, is back down to 2%, and they're confident that it's going to stay there. So it's likely we're going to have higher interest rates for quite some time, unless we really see the situation change dramatically where we get into a bad recession, lots of unemployment. You can expect the Fed to be creating some serious, well, we'll see how much pain, hopefully not a lot of pain, but creating some pain until they get that inflation down. Some good news from his perspective, from the Fed's perspective, the economy is slowing. That's good. The economy's been pretty much flat. This year, it fell a little bit. The GDP fell, real GDP fell a little bit in the first couple quarters, and then it came back in the third quarter. It's been sort of at the same level of the fourth quarter reading, right around 20 trillion. It's the largest the economy's ever been in terms of size. Real GDP, so inflation adjusted, is just over 20 trillion. That's the biggest ever. Growth in consumer spending is starting to slow. That's also what he wants. We'll talk a little bit later about this idea of excess savings, of how much money people have in their bank accounts, more than typical. It's somewhere in that 10 to 10,000-ish, 10 to 15,000 range that a middle-class family saved above the pre-pandemic trend. And the Fed chair was more explicit about complaining about that in his November presentation, where he was talking about how all this extra money that people have and this spending consumer is making it harder to slow the economy. But it's sort of, he's saying the economy is really strong, great labor market, people have money to spend, and that's part of why it's hard for the Fed to slow down inflation. And that's where he gets into the last paragraph of just how strong the labor market is. Extremely tight. 2 open jobs for every person that's unemployed. The unemployment rate hit the lowest since 1969 in July at 3.46% when you go out an extra decimal place. It's still very low. It's been in that 3.5 to 3.7 range since March. Historically, the average unemployment rate is like 5.7, 5.8. So, I mean, this is very low unemployment. It's a great time to be a worker and we're looking for a job. Let's keep going. But I would encourage you guys to read these things. If you go to it's not hard to find them on the Fed website. Now, this was really interesting. This is their latest forecast that they released literally last week. And the way this works is you got the years across the top, and then you've got only 5 variables if you include the interest rate. But what they're showing is where they were in September and where they are now. So like that first 2 rows is the real GDP December forecast, and the other one is where they call their September projection. So you can see the change. And the change in real GDP in 2022 up a little bit, but 2023 down, 2024 down. The unemployment rate goes up a scary amount from 3.7 or 3.8 to 4.6. And to put a concept on that, there's about 160 million people in the labor force. And the unemployment rate is the percent of the labor force that is unemployed. So if you raise the unemployment rate by 1 percentage point, you're talking about 1.6 million jobs. That's 1.6 million more unemployed people if that forecast is accurate. PCE inflation, they actually noticed that despite a worse economy, they bumped it up, meaning they're saying we were really off before in our September projection. Not only are we projecting that things will be slower, which in theory would bump up the inflation rate, but things would be slower, meaning the inflation rate would be lower, but they're actually bumping up the inflation rate and slowing other stuff down. So the relationship of inflation to the unemployment rate and the GDP has shifted in this forecast from the other. They're saying it's just inflation is going to be worse, even though the unemployment rate and the GDP are also worse. They should go opposite directions. And so the PCE inflation down there to the core, and the federal funds rate, look at that, much higher. In 2023, that 5.1% versus 4.6. They're saying we're going to need the federal funds rate, which is their inflation rate that their interest rate that they manage. That's their big sort of lever that they use for the economy, is going to be a lot higher than they said before. And so this is quite a big shift in their forecast. And not only saying things are going to be worse and our policy is going to be more restrictive with higher interest rates, meaning ours, meaning Fed, they're also saying the inflation is going to be higher than we thought too, despite everything being worse. So it's really kind of even though this is a fairly simple set of numbers, it's quite profound in terms of what he's saying. That we were wrong before. We're raising the rates higher than we expected, and things are going to be worse than expected to get this inflation rate down. This inflation is really stubborn.
Yeah.
Let's keep going.
During the break, we took a quick look at the recent PCE monthly rates. I don't know if you were around for that, but especially in the overall PCE inflation, the last 4 months don't look scary at all.
Let's hope not. Yep. So here's some. Go ahead.
They amounted to a 0.8% increase over 4 months, which is about a 2.5% annualized inflation rate.
That's a good point, Carl. One thing that I think is really important that the Fed does is they do try to scare people. They want people to think the economy is crappy because what it does is it scares corporate types into not investing. They say, oh man, things are going to get bad. Let's not spend any money on stuff. Let's not hire workers. Let's not do any more capital investment, or in other words, cut their capital investment. So it's part of using the bully pulpit of the Fed is to scare people a little bit. But I agree with Carl. I think the data is a little better. I think hopefully we will get through this without getting into as bad a shape. I think it's pretty big jump in unemployment to get to 4.6 next year. But, let's hope I'm wrong. I hope the Fed let's hope I'm right and the Fed is wrong, that unemployment gets to maybe 4%, 4.1, doesn't get to 4.6 or whatever they're saying.
Yeah, what's concerning me about Chairman Powell is that rather than talking about what's actually happening on PCE inflation, because those numbers are not scary, he's talking about, there's, upward pressure on wages. There's, households still have excess funds they can spend. All these things that might potentially provide some upward pressure on inflation, but we're not seeing it in the actual inflation rates that are being tracked in the economy. And I'm worried that, Chairman Powell and the Fed are fighting this phantom potential inflation as opposed to actual inflation. Because as some other, graphs, as Robert Reich, among others, who talked about, there may be upward pressure on wages, but companies have, for the most part, fairly high profit margins, and they can pay those wages for the most part out of their profit margins, even if they can't raise their prices. So we may not, that upward pressure on wages may not flow through to higher prices.
Yep.
So
let's hope. So this is just some other quotes from the Fed about what do they expect to see for inflation to come down. So growth to slow, bottlenecks in goods production are easing, which is good news. The supply chain is cleaning up. Housing services inflation, meaning rent, dropping, and then the labor market slowing a little bit higher, maybe the wages not going up so fast, and the unemployment rate being a little bit higher. Hopefully first what we'll see is the number of job openings falling quite a bit, and then we would see probably higher unemployment if corporations are letting people go. So another important thing the Fed looks at is investor inflation expectations. And this is a kind of a real-time daily number that they have access to, which is really, I think it's a daily. Yeah, I think it's daily, maybe weekly. But they are seeing that investors are expecting inflation over the 5 and 10-year range to be about 2.3%, which is a very nice low number. It's been coming down, as you see from the March timeframe there. And the Fed's funds rate this was before the last Fed meeting. So that rate should be about 4.3, pardon me, where that blue dot is over there. It's come up it's even a little bit higher. The Fed, this one now shows that the nearly all the measures that are used to call a recession, to call that there's been an economic peak and now things have fallen below that peak, all those key measures are actually up for the year, and they're up since June. So that vertical line, they're up since then. So this tells us that the economy is growing and not going into recession. So despite the fact that the GDP slowed a little bit in the first couple quarters and that's since reversed, the economy has been sort of treading water. We'll see what happens next. If GDP falls and the unemployment rate jumps, then we'll know we've peaked and we're going into a recession. But as of right now, things are looking good. The latest readings for each of those numbers is showing growth, not recession. Now, this is an idea you'll hear sometimes about the inverted yield curve. It's kind of a technical topic, but in theory, long-term interest rates for long-term bonds should be higher than short-term because people are locking up their money longer. They're taking more risk and saying, I won't expect you to give me my principal back for 30 years, or 20 or 10. A lot can happen over that time versus, say, a couple months or a couple of years with a short-term bond. So a common way to look at this is this, and I think I got a label there where I said long-term 5-year. It should say long-term 10-year. The short-term is 2, so it's a 5 and a 10 year. It's a 10 and a 2-year graph, and it shows that on the top. Just can't read my own the Fred writing, but the inverted means the short term has gone above the long term, and this is usually looked at as a sign that a recession is coming. And it's not always clear why. They're correlated, but there isn't necessarily correlated, meaning they go together. When you have an inverted yield curve, meaning the short term rates are higher, people think you're going into recession, and so. The question is, what's the mechanism? Why is it that an inverted curve might produce a recession? And let's go into that on the next page. And hopefully you've seen Top Gun, where he explains how did he get such a good photograph of the MiG fighter. It's because he was inverted. So I had to put that on here. We don't do much humor in this session, so there's your humor for the meeting. How did you get the picture of the MiG? It's that scene where the cockpits are sort of right touching each other practically because he's upside down on top of this MiG fighter. Kind of the chain of events here is that you look at the graphic, and I've got a quote from Fed Governor Dudley. He's retired now, but he did this fairly lengthy description of why a yield curve, in his view, really doesn't matter. There's a key excerpt from it up there, but the way he kind of explains it, he says investors expect a recession. So they expect that the Fed's going to lower interest rates to boost the economy eventually, and that so that they expect interest rates to fall. So investors would, in theory, thinking that we're going into a recession, would be selling their stocks and buying bonds to protect their principal. They'll buy short-term bonds, they'll buy long-term bonds. When people are buying something, that drives up the price. And then if bonds and the bond price and the bond yield mathematically go in opposite directions. And so if the price of bonds is going up, the yield is falling. So let's say there's a bunch of investors that are scared of a recession. They're buying a bunch of long-term government bonds to protect their principal. They know they'll get the principal back. And so by doing that, the yield falls. And that's part of why you have this inversion of if they're buying a lot of these long-term bonds, that yield is being, there's pressure, it's being lowered. The other thing is the Fed is jacking up that short-term rate. So you have the sort of two forces working, the Fed jacking up the short-term rate, investors buying those long-term bonds, selling their stocks, buying the long-term bonds for safety, and that is driving that yield down. So this is one way of thinking about why you see this behavior, why you see people worried about recession causing a yield curve inversion. And so it doesn't show up on this graph, but the causation goes clockwise here. It starts at the top center and goes around. Sometimes when we use a PDF, I don't know if is this the actual PowerPoint or is this a PDF? I'm just curious. Because sometimes stuff happens on Google where there are arrows going clockwise on here, but that's how it goes. So we're clockwise on that chart from the top, and you'll have the method. But the Governor Dudley is sort of like, they go together, but I don't see necessarily a causation mechanism. And sometimes these yield curve inversions they're false positives, meaning they happen, but you don't have a recession, but often you do. All right, so the Federal Reserve Bank of New York has the probability of recession in the next year at 38%. That's been coming up since about 25% in August. And they use this combination of long-term and short-term interest rates historically to try to make a prediction about inflation probability. So that's a fairly high probability. You can see that it's kind of cramped over there far on the far right side of the graphic, but it's getting back to a fairly high level from the last 3 recessions that we've had. It's almost there. It's just a little bit below them. So you would think that if the economy is at this fantastic, lowest unemployment rate since 1969, record number of people working, that we're pretty darn close to a peak, right? Success is it's going to run out eventually. You're not going to continue to be going down to 3% unemployment unless something really strange happens. So you're going to have a peak soon, and they're saying, okay, well, probably about a 40% chance of it. There are a variety of estimates across different economists I've seen going from, usually they run from about 30% to about 60 or 70. Aren't too many guys that are saying certainty about a recession. Too much can happen. Now, some good news, when you look at the position that consumers are in, the bottom 50% real net worth group is at right near a record net worth. And this is real net worth, meaning adjusted for inflation, at $68,940, just a hair below where it was in the second quarter of this year. It came down just a hair, as you can see in that upper right corner, but it's still very high. And so another nice thing that Biden can tout is this enormous increase in net worth of the bottom 50% group, up 50%, 52% since he started, up 83% since pre-pandemic. And that's very good news. This is mainly driven by housing, which is the primary asset of the bottom 50%. That group has very little wealth in the stock market. So the fact that the stocks have been taking a beating doesn't hit this group very hard. It's mainly their housing, which is why you see that huge dip in that 2005 to 2010. That was the housing crisis, where the housing values got crushed and a lot of people were highly leveraged in their homes and took a real beating from a net worth perspective. So this is a very good number. The data was just reported, I think it was late last week, maybe Thursday or Friday, from the Fed. It's called the Federal Reserve Distributional Accounts. You can see it at the bottom. You search on that, you'll find it, and then you can also find this spread chart if you're interested. But it's an involved chart just because you have to adjust for inflation and divide by the number of households. But eventually you get to these numbers. I think, do I have another one? Let's see, for other groups on the next slide or not? Oh, okay, another one on this subject. But you can see from when Biden started, the bottom 50% group is the only one with a big net worth improvement. The other groups have all taken a hit, and that's mainly because they have a lot more in stock. Well, I shouldn't say that. The stock market is fairly flat from the first quarter of 21 to where it is now. So this is almost all inflation, just taking a chunk out of the net worth of people. That's why the real net worth is down about 6, 7, 11%. Inflation has been more than that over the past couple of years, but also those groups own housing as well, which is up. So it's sort of, the stock didn't really make much of a difference for this group for that time frame. But it is the housing is sort of offsetting the inflation to some extent. We'd rather every group is going up, but that's the way it is. Now, when you look at, this is the number from just showing the specifics of each one. So the prior chart was percent changes. This is the endpoints, the first quarter of 21 and the third quarter of 23. So what it shows, and let me use the top 1% column, so we'll just work down that. Again, this is real numbers, so 2022 dollars. The top 1% group had 46.3 trillion in net worth. In the third quarter of 2022, that was 41.4, so it's down 4.9 trillion. That's an 11% decrease in this case, minus 11. The share of the decrease, meaning that 4.9 in the third row divided by the 10, which is in the far right column, that third row, far right column, the minus 10, is about 49.5%. That's where that comes from. So their share of that increase is about half of it, hit the top 1%. The share, because they have half the net worth, they have a lot of the money. The next row down, the share of net worth in the first quarter of 2021, they owned 31, almost 32% of the net worth. So that is the first row, the 46.3. divided by 145.3, that gives you the 31.9. And the share of net worth in the third quarter of 2022 is 30.6. That would be the 40.14 trillion in the second row divided by the 135.3 in the upper right there. And then the change in share is just the difference in those two rows just above it. The top 1% have seen their share of the wealth fall by 1.3. The next group, 90th to 99th, down 0.2. And then the bottom two groups have seen it go up, actually. Their share of the wealth has gone up, although barely for the 50th to 90th group. So this gives you all the kind of share and change and percentages and all the things you have for that, for this change in net worth under Biden. And I think if it wasn't last month, it was 2 months ago, I did this with the second quarter statistics for all the groups. We looked at it, we did all the groups, but we went back to 1989, which is the oldest part of the Fed data. And then we also did one, I think, back to the pre-pandemic. So the numbers haven't changed enormously since the last quarter. The trends are pretty much the same, but you can see kind of what's going on with the net worth. But it's great news for the bottom 50%. They've never been this rich. Now this is housing. This is the median sale price of houses that actually got sold. And the nominal number is what is the dollars they actually sold for, and then the real is the adjusted. You'll always see this pattern when there's inflation with the real sitting above the nominal. So lately, the number is 454,900. The real price is up almost 40,000, 10%. The nominal price is up 85,000 or 23% during the Biden administration. Those are huge gains. That's $80,000 improvement in your home price on an original starting price of 370-ish, 370 or so. That's huge, and inflation took a chunk out of that, but still, up 40,000 is a pretty nice chunk of change, and that's a lot of what's driving the net worth of that bottom 50% group. The stock market now, let me start with the right-hand chart because it's simpler. From the time Biden was elected until now, as of Friday last week, the stock market's up 14%. The stock market had peaked up 42%. Republicans and the media love to talk about kind of where we've fallen from the peak, but the fact is, from the time Biden was elected, we're up nicely, actually. And Trump also started taking credit for the stock market from his election. So if he can do it, so can Biden. You don't have to start with Biden's election day. The stock markets are leading indicators. They look at what they think is going to happen and they price accordingly, adjust promptly. The left-hand side talks about why that stock market may be traveling the way it's doing. And with the exception of kind of what happened in 2020, where there was that huge drop because of what's going on in the real economy, 20 million people lost their jobs, and we didn't know exactly how bad that pandemic was going to be. Other than that time period, stock market tracks very well with what's going on with the money supply. And lately, you can see that even though it's not falling a lot, the money supply has been coming down, which is unusual. It was going up pretty much all the time up to this point. And then, you can see where the Fed announced that they were going to start cutting their balance sheet, cutting the money supply. And they began to do that. And lo and behold, the stock market is falling. And you can expect that to keep happening as long as that money supply is coming down. The Fed is being restrictive. Stock market is going to come down. The stock market is not, and Carl says this a lot too, Wall Street is not Main Street. The stock market is much more sensitive to what the Fed is doing than what is actually happening. If we were just talking about jobs, the stock market would be at an all-time peak. It would be right there because jobs are at an all-time peak. That's the real economy. That's Main Street. That is not what's happening here. Wall Street is reacting to what the Fed is doing, raising interest rates, which, as we talked about, asset prices and interest rates move in opposite directions. Mathematically, it's going to happen. Strictly, it must happen with bonds. It's very highly correlated with stocks. So any questions on that? This idea of the money supply driving the stock market we haven't shared that before, talked about it, so we'll get into it in more detail another time. But that's kind of something to keep an eye on is what's happening to that Fed balance sheet. Now, this idea of excess savings, we've talked about before, it's the same chart, but I love this chart, and I think it has a lot to do with why we have inflation right now. Because of checks from the government, because of the big wage increases, and because people weren't spending on services in 2020 and 2021, people saved a lot more money than you would think relative to the sort of pre-pandemic trend. The savings rate was much higher in that 2020 to 2021 period. And so you can see by different groups, by income percentile, the middle class, those middle two bars, somewhere between $8,000 and $16,000 of additional savings available to them as of the second quarter of 2022. I don't have the latest one. I don't have this data yet for the third quarter. I have not seen it. It was a study that's down there at the bottom, which I think you should all take a look at. A lot of interesting information in there and charts. It was really a great study. And they talked about also where it came from, like where this money, how much of it was checks, how much of it was wages, how much of it was savings. Point is, this is what the Fed chair is complaining about, is that the consumers have a ton of money to spend. And we'll see how Christmas goes, the holiday season goes, but likely to be very strong because people have a lot of money. And we'll see. So this is part of why I think we have inflation, is because people have a lot of cash. I already showed you the bottom 50% have record net worth, although the others don't. But in terms of what's in their bank accounts, everybody's in pretty good shape, relatively speaking. Now, of course, there are people that are suffering, but for the most part, on average, all the different income groups are in better shape than they were pre-pandemic. This shows, it's the data from the prior chart. And so the second quarter of 2022, that vertical line, that is where each of those lines are. So like the red line, 25,000 here for the top for the top quartile is the $25,000 bar that I showed you on the prior page. What I did here is I took the data and then said, how long is it going to take people to run out of this money? And I just assumed that it's going to be running off at about the pace that they were being spent down the last couple of quarters. So you can see the last couple of quarters of Q4 of 21 and the first quarter of 20, I'm sorry, the spending down in the first quarter and the second quarter. I just assumed that continued. And what you see is the top quartile, that red line, goes to negative by the end of next year. The blue line also goes negative. That's the bottom group, and it goes down to zero in the middle of next year. But the middle class, if they continue to spend down slowly, they're not going to go down in the time frame before the Fed really, by the end of 2023, they'll still have a significant amount of savings, but it's going to be down from where it was. So we'll see if that proves out. I just wanted to give you a sense of how long this excess savings can help us. Chances are it's going to be running out by the end of 2023 for the most part. And so, it's going to be tougher. That's why it's harder for the Fed in some cases to slow this economy down, is because people have all this excess cushion to use to keep their spending going if they want to. This is a couple of other slides, just kind of some miscellaneous stuff. There was an interesting article in Vox that's linked down there. You're starting to see some of these year in review charts, although we get those more in January. But this, in-person activities are mostly back to where they were pre-pandemic. So hotels, sports. So this is the services. And this is part of why those services, you're starting to see inflation, is because they're back almost to where they were. But notice that the offices are way down. So those downtown restaurants that serve lunch and stuff, if they're still open, are still hurting. And then the concerts are still down a little bit, which is interesting. But air travel and the others are back to a reasonable percentage, or a pretty solid percentage of where they were. Another chart from Vox, this talks about if you can work remotely, you are. So they say in the upper right there, a full 78% of Americans who can work from home are doing that, either hybrid or remote. So this has jumped considerably. People have sort of looked at this now as a perk of working. Not everybody can work from home, obviously. If you're in manufacturing, you can't manufacture in your living room, but it's a nice deal for the office workers that are able to do that. So unions are actually had a pretty good year in terms of bumping up. And, it's one thing when think of a union as the unions that compete internationally struggle. Like it's really hard for a company to spend the costs, pay U.S. wages if they're competing against companies that are paying fractions of that to their workers overseas. But when you look at services like McDonald's or somebody else, there's no reason for a McDonald's that can't be unionized, or others. The wages tend to be like 10% or more higher in unionized shops, and you have more benefits and everything else. So the unions had a pretty good year, best year since 2015, even though starting a union is no easy thing. So, services that don't compete internationally, there's no reason why they can't be more and more unionized to help workers, because I think you all know that corporate profits are not suffering. They're also at a record level. And, no reason for some unions to get built to pull some of that back into the labor section. All right, let's keep going. This has to do with what percent of the different parties are vaccinated. And not strangely, most people on here probably know this, that political party has been one of the major indicators of mortality from COVID. And the causal part of that is the vaccinations. So the vaccination rate of Democrats is about 94%. That's that blue line on the top, and it's been high for a long time. Whereas the Republicans have sort of peaked at about 70. I'm sorry, that's the independents, and the Republicans are in that 64 range. It looks like they may have been, occasionally they'll jump up a little bit. And you see in the green, 33% of Republicans say they refuse to get vaccinated. They'll never do it for whatever reason. And the Democrats are at 4, meaning we're paying attention to the science. So hopefully there isn't some kind of horrible disease that we'll all get from this, or this country will be run by Republicans. But right now, who's dying? I'll show you on the next chart. The excess deaths are in Republican places. And there are different studies that do this, but this was a one that was an NBER working paper. So that usually strikes me as something that's going to be more credible. There's a guy on Twitter who also is very good at this. His name is Charles Gaba. He does some of I want to say ACH, not ACH, ACA website. You may have heard of his stuff. He does a lot of work with the Affordable Care Act and tracking it and all different kinds of things about it. But he talks about this. And so this study says, adjusted for age and other factors, so that's a key part of this, that Republicans are dying at a higher rate than Democrats. And I'm not sure I fully understand the percentage exactly, but it's excess deaths, meaning more deaths than you would expect, adjusted for a variety of factors. I just wonder that I can understand that 10% more Democrats may die, but 30% more Republicans than you would expect dying seems rather high. But that's the study. It looked at 2 states, Florida and Ohio, 2018 to 2021. And whether you like the percentage or not, you can read the study, but it's significantly higher for Republicans because they're not vaccinated. That was the conclusion that the study came to. Unsurprising.
Excuse me, David, but
Yep.
wouldn't it be, I don't know if this is true or not, I'm just thinking this, because a lot of Republicans probably are older people.
Right. This adjusts
'Cause-
for age. That's a key. That's a great point you bring up, because that's very important. Republicans are older on average, and that is adjusted for here. So, and that's kind of, okay, that's why that percentage is probably so high. They're just doing percent of percent stuff. It's percentage points is probably a better, the overall, the excess death rate for Republicans was 5.4 percentage points higher. It's adjusted for age, just to answer your question. They adjust for different factors. And you can see that in the first paragraph in the upper right. It says, our approach estimates excess death rates as the percent increase in deaths above expected deaths that are due to seasonality, geographic location, party affiliation, and age, meaning they've adjusted for those things.
Okay, thanks. I see that now.
Yeah, it's tricky. I was wondering about that too when I read it, because that's a really key point. And there's some other studies that were done that were sort of people were arguing against them, saying, well, yeah, but people are older. What are you going to do? Like if you compare Florida to California, and Florida has a higher average age, let's say, then it's not fair to compare it with, unless somebody adjusts for that. And I think that's where that expected death rate comes in handy, because if you expect a certain death rate in Florida, let's say, because you already know that it's based on the history, so it's already built in there, and the deaths are higher than that, then you know that something unusual is happening. And that's kind of, I think, how they looked at this, is they used excess, meaning they expected a certain amount would be, based on history, would happen, and they got higher number.
Excuse
right,
me
so
again.
then-
Yeah.
Yep.
I was just thinking another thing is just, this is anecdotal, obviously, but I just think like Democrats will like more likely wear their mask. I still wear my mask, like if I'm in an
Oh, yeah.
airport, an airplane, and I just don't think Republicans would.
Right.
And I
No, I
think
think that's
it's,
true.
and I think it's still important to not get COVID if you don't have to. So I don't know. I'm just was thinking that even Republicans I know that are vaccinated, they're less likely to just be wearing their mask as much, I think. But I don't know. Maybe
Right.
that's just around
no,
ours.
no. I think that's right. I think that's a part of this, and then also I think the risk taking, like a Republican that just pretends COVID is the flu, might just spend a lot more time in crowded places, whereas others don't. Like I do curbside pickup for groceries. I haven't been in a grocery store in years. It's 2 years, going on 3 years now. So it's I order it online and pick it up. It's not rocket science, and I don't go in. But a lot of people do, and it's just not necessary. You can go to, you don't have to unless you're in certain, I guess maybe there are certain parts of the world that don't offer it, but like Mariano's out here in the Northwest Burbs, you can order. Prices aren't significantly different. It's a fantastic service. You show up, they drop in your trunk, you go and drive home. All right.
Yes.
Good points. Let's keep going. So we usually talk about things you can do to take action. We have a couple slides that are easy to cut and paste and use for that purpose. So let's take a look at one. This is sort of a summary of all the key statistics, or not all of them. Be a lot longer than this, but a summary of some key statistics. You can, hopefully you know how to use your cutting tool. You can drop this into any social media that you have and just say, hey, the economy is doing great. Record number of people are working. Finances for households are fantastic. The economy is the biggest it's ever been, and the deficit is actually below the 2019 level. And Carl will tell you, I guess it's a little strange with the Obama era, but generally the budget deficit only goes up. It doesn't usually fall, and it's certainly weird that it's below 2019 if you take student loans out, which right now student loans are out. The deficit in 2022, it was lower than 2019 in dollar terms and much lower as a percent of GDP if you take student loans out. So there is a lot of good news to report, and I use real statistics. Carl and I use real statistics wherever we can. That means the inflation has been factored in, because the usual Republican refrain is, but what about this high inflation? It's like, well, that's in the real statistics. Real net worth, real GDP, real hourly wages, those are all adjusted for inflation. So those put the inflation into context. This is, I think, is Carl's actual favorite slide. There it is, updated with the latest measures. Carl, do you want to talk about this one? You did a
Sure.
service.
When in the summer of 2018, the Trump administration started touting that he was presiding over the greatest economy ever. And this column shows what the economic statistics were in that, quote, greatest economy ever. And then the last column is what's the latest data under Biden and how does that compare? The unemployment rate slightly lower, jobs are slightly higher, GDP is higher, employment to population ratio is a little higher, real wages are higher, especially the net worth of the lowest 50% is high, substantially higher. The real net worth of the 50th, 90th percentile is a little higher, and the stock market's a little higher. Comparing Trump's greatest economy ever to the current economy, we're better now.
A point entirely lost in the media, but going into the election was inflation, inflation, inflation. And this is part of the battle that Carl and I have been fighting for a while to try to get the word out that, no, the economy is pretty darn good. So,
And
all right.
note that a lot of these numbers are adjusted for inflation. We talk about real, that's adjusted for inflation. Real GDP, real wages, real net worth are all adjusted for inflation.
In our second attempt at humor, I ran across this joke in a wonderful book on economics. If you are an econ reader, let me grab it really quick, but I'll let you read the joke while I grab the book. Hang on. This is the book. It's called The Economist Hour. It's by Benjamin Applebaum, who's a New York Times guy. And he has the joke is in here. It's attributed to one of the economists he covers, but he talks about, it's a really interesting discussion of sort of the economic history of the post-World War II era till now. And he gets into sort of some of the thought leaders of the economics profession. But this joke, I thought, cracked me up considering the subject material. I did not expect that ending. So now you have, if anybody needs an economics joke, you have one. I think that's it. There's some links that we have on the last page that you can go to that talk about why the economy is better under Democrats. And if you're using the PowerPoint, you can just click on those links and it'll take you there. But the economy does way better under Democrats on almost every measure you can imagine, regardless of who controls Congress. There are some threads that you can use that have different economic updates in them on Twitter, others, and some of them are chains of things, meaning you've got a lot of the slides that are in this presentation are actually in there. So you can use those. There's also a Wikipedia article that talks about how much better the Democrats are for the economy, and there's a bunch of other sources in there that you can use. I check on that article every now and then to make sure it's okay. It's been a little while now, but there's enough people policing it to where it's pretty reliable. So feel free to use those sources and share them. Really easy to share that New York Times article and commit that one, keep that one on your ready list to drop in different social media whenever you feel the need. But regardless of the Congress, the president is a Democrat, you're going to see the best economic results, and it's not close. And Carl and I, was it 2 months ago, Carl, we did the presentation on the Democrats better for the economy, or is it further back? Was it September?
Might have been 2 months, might have been 3 months, not sure.
Yeah, so check, if you guys have this, and we do it every year. We share that, we update that presentation and we share it. But it's got a bunch of slides you can use to talk about how wonderful the Democrats are. And that is, that one you can probably, if you're on the mailing list, you just look back the last couple of months, you'll see a couple of presentations, the regular one we did, and then that one included in that meeting. I think that concludes our prepared remarks. So we'll open it up for any questions, and